In over 120 countries, there are RSM experts who take time to find out what makes you and your business tick. Wherever you are and wherever you want to go, our audit, tax and consulting services are designed to help you move forward with confidence. It's your ambitions we care about, and like you, our focus is on your future. The advice you receive may come from individual RSM experts, but it will be supported by our collective local and global knowledge, helping you grow and safeguard your future. That's the value of RSM. That's the power of being understood. At RSM, we have over 40,000 great minds that take the time to find out what makes you and your business tick. Our audit, tax and consulting services are designed to help you move forward with confidence, but it's how we do it that sets us apart. RSM's experts take time to understand what matters most to you, which means you receive advice that goes beyond your expectations. What you'll notice is the lengths our people go to understand the hurdles that stand in your way, and then to find innovative ways to help you jump over them. That's the value of RSM. That's the power of being understood. In over 120 countries, there are RSM experts who take time to find out what makes you and your business tick. Wherever you are and wherever you want to go, our audit, tax and consulting services are designed to help you move forward with confidence. It's your ambitions we care about, and like you, our focus is on your future. The advice you receive may come from individual RSM experts, but it will be supported by our collective local and global knowledge, helping you grow and safeguard your future. That's the value of RSM. That's the power of being understood.
Okay, thank you, DDT, for the introduction. On behalf of RSM Indonesia, we welcome you to our regular webinar. So the aim of the session is basically to provide updates on key international tax issues, both what is happening globally and also in Indonesia, the impact to Indonesia. This afternoon we'll have we will have two sessions. The first part is transfer pricing updates, though there are no new regulation issued recently, but I think it would be best if we provide you update what is happening within Indonesian transfer pricing environment under the current regulations. And the second one, it is privilege for us to have Ibu Melani Dewi Astuti, Ibu Melani Dewi Astuti, the International Tax Analyst within BKF, and she will join later on. But prior to such introduction of each speakers and also the issues that will share to us, I think I'd like to remind and to update you or to share with you on RSM. So next. So it's been also share in the video that RSM is a global firm. We present in 123 countries with more than 50,000 staff, including 4,000 partners and almost 900 offices. And in Indonesia, we do have 2 offices in Jakarta and Surabaya, and we have more than 700 staff with more than 40 partners. Next. Our services, I think we highlighted this in the video, that our major services includes also the biggest part is audit assurance practices, followed by tax services and consulting services. Next, the services in details, I think what is relevant for us, because this is the tax updates. So this includes, our services, tax services include business tax, international tax, tax merger and acquisition, transfer pricing, and also tax dispute and resolution. Next. Yeah, next. Yeah, I will be the moderator of the session. I'm Ikhwan Sukardi. I'm the head of tax practice. And as mentioned, our 2 speakers would be Salil, our tax partner, head of transfer pricing in international tax, and we'll have also Ibu Melani Dewi Astuti, which whom will be joining later on. She's the international tax analyst at Fiscal Policy Agency, or BKF, within Ministry of Finance offices. Salil has more than 10 years experience in international taxation, and she joined RSM Indonesia, I think back last year, and you will note also that he published already some articles in international tax and also transfer pricing. He completed his education, obtained bachelor degree from Punjab University in India, and obtained professional certification from Chartered Accountant of India, and also executive certificate in international tax and transfer pricing from Leiden University. So he will share with us on TP audit and trends, and also update on COVID-19 implication on manufacturer and also distributor. Then the session, the presentation itself would be around 30 minutes, 30 to 45 minutes, and then will be followed by Q&A. So Salil. So the webinar itself, I think if you have questions later on, then please write in the chat box, and then our team will summarize, and then will be also it would be best also if the question is specifically addressed to which speakers, and the questions may write whatever the convenient for you, both in Bahasa or English, and then I will lead the discussion. I will select, because there will be if a lot of questions, and I'll select which one is more relevant, and we'll also summarize those are similar questions. The slide will be provided, the link will be provided to the participants upon completion of feedback, and the link to the feedback will be available in the chat box. I think those the guidance of the webinar, and please ensure that you put in the silent mode of your or mute mode of your speakers. Thank you, and time is yours, Salil.
Thanks, Ikwan, for the introduction. Good evening, everybody. And I'll just share my presentation. Ikwan, I'm not able to share my screen. Afri, maybe can you help? Afri, can you enable my screen sharing? Yeah. So. All right. So as Ikwan has already introduced, I will be sharing my presentation in 3 portions. Firstly, we are going to discuss about the contentious transfer pricing audit issues and the trends that we are observing in Indonesia. I'll spend time on 5 cases here where you will get to know about different aspects of the more contentious issues that we are facing in the near time. Then I will move on to some of the COVID-19 related challenges that we are facing as you know, Indonesia is a manufacturing prone economy. So a lot of COVID-19 related challenges are observed, and we will share a few and how the guidance can be used to do compliance with respect to the COVID-19 challenges. And then later on, if time permits, I will also give a brief of the revised guidelines from the OECD 2022 model. So I'll firstly discuss the cases, and then I'll discuss the detailed regulation regarding the segmentation available in the Indonesian regulation and OECD, and what are the key takeaways. So here is a distributor, and the distributor is involved in purchasing the products from a related party as well as from independent suppliers, and they are making sales largely to Indonesian customers. Right. So the key facts that we noted is that it's a normal distributor and is distributing 2 kinds of products, but the products are different when it comes to the level of service required and the level of hand-holding needed to make the sales. And in this regard, the company does an overall TNMM because it's very difficult to segregate the allocation of efforts and the profits for the related and unrelated parties separately. But similar products are distributed to both the products are distributed to related as well as unrelated parties. And since it's a global group, the search policy was also consistent, and this was squarely applied. to the facts of Indonesian transfer pricing. The tax authority during the scrutiny requested for providing the segmented profitability, and the company obliged to that request. But in the request, the company shared an Excel spreadsheet, but clearly allocated that certain costs is incapable of allocation. But the intent was that they can share some guidance to the tax office on how the group operate and what kind of cost structures are available. But the tax officer used that segmentation to conduct the tax audit, and for the non-allocable basis, he simply applied on the ratio of sales without giving any justification, and accordingly computed that the transfer pricing is not in line with the industrial comparables. So here, I think the key takeaways that we can learn or apply in practice is that we need to look at the availability or the capability to segment the activities very clearly. And if it is, because if we don't have that segment initially and we provide it later on with caveats, it can be a little confusing. So it should always be, one should always be careful in applying the policy on a consistent basis. And the search criterias in Indonesia, the tax authorities follow a very very practical way, and we usually try to prepare our the benchmarking in a way that matches with what the tax officers database are and the kind of policies that are practically implemented. But there are times where we don't find comparables, especially which matches the product or which matches the industry, and there you have to sometimes do broad base, but along with appropriate reasons, and ease out so that you can make a relevant comparison. I think the key idea here is that we should prepare the segmentation with a very clear mindset that whether this is possible of identification, and if it is not possible of identification, we should clearly mention in the transfer pricing documentation that there are some overlapping and clear distinguishment, and the profitability cannot be assessed, and we should consistently apply this. The second is similarly in the case of a manufacturing company also, the contract manufacturer operates on different services, and some of those are provided to third parties, some of those are provided to group companies. The agreement says, as per the agreement, the company needs to follow a cost plus 10% policy, but this is just a guidance, but on practical basis there is some some plus and minus depending on the contract, depending on the services. So it's not ideally followed, but on an overall basis it is followed. The taxpayer prepared a segment in their transfer pricing documentation. So unlike the previous case, the company did not prepare the segment, and the tax officer asked to prepare the segment and use that to make the judgment. Here, the company prepared the segment. The tax officer felt that this is not justified, and is not able. The reasons that the tax officer feels is that because the company is doing same level of broad service, so they should not be doing a segmentation. And segmentation is only possible when you are doing different functions. For example, you are doing manufacturing and distribution, then only you should segmentation. You should do segment. And accordingly, the tax officer again disallowed the segmentation basis and considered the overall benchmarking and applied it to the overall business volume, and expected the company to make those kind of margins on the overall basis, and made tax adjustments. Here again, the key takeaways are that allocation fees that we use while conducting the segmentation in the transfer pricing documentation needs to be very fair, consistent, and should be logical to prove. For example, if you are you cannot follow everything on the basis of sales. So if there are certain expenses that could be allocated to assets, they should be allocated to assets. Allocated to human resources, they should be allocated that way. And a consistent policy has to be followed across the group and within Indonesia. And secondly, if the conduct is not to squarely apply 10% cost plus on every individual agreement, then the language should be appropriately modified, because sometimes the tax officers look at applying the agreement very squarely, and though they do understand that the transfer pricing is more to do with the intent and object, but they still sometimes follow the agreement. So let's see what the guidance is available in relation to the segmented financial statement, because as we saw, the information is applied differently in case of a distributor and manufacturer according to the preference of the tax officer. Here, the OECD also recommends that wherever there is a possibility that the controlled transactions and controlled transactions can be separately identified for profitability, then it provides more reasonable basis and more accurate basis. And one should not follow the overall TNMM or a company-wide basis of profitability as a thumb rule. And the effect should be to do as close as possible to compute the profitability. And even Indonesian regulations, unlike many countries, they have specifically mentioned in the regulations that taxpayers can determine the type and documents related to the business that supports the arm's length price, including the words including segmented financial statements are of high importance here. So even the Indonesian regulations also suggest that the segmented financial statements should be available, and in practice we have observed that the tax officers invariably ask for segmentation and want to see the profitability of the intercompany transactions and the third-party transactions separately. There is another circular which also supports the segmented financial statement application for the computation of results. Again, this is a very particular scenario, and we face this issue on a regular basis, with clients all across. And segmentation should be applied only when you have the ability to allocate proper keys, you have the bandwidth to map certain details within your ERP and systems, and accordingly you need to track, and you need to be very consistent on the application, and one should not flip between the segment in 1 year and apply overall results in the next year, because this inconsistency can in some year benefit you, and some year it can hurt you. But at the same time, that this inconsistent policy will also have repercussions from the tax office. The third case law is regarding the application of CPM. Now here, the taxpayer is a captive manufacturer, a captive contract manufacturer, and is doing two kinds of product. One product is regulated in the commodity exchange. The other product is not regulated in the commodity exchange, but it's very similar to that product. The taxpayer uses the TNMM to test the results of the pricing and make some adjustments in the year, because they had significantly enhanced the capacity, or had bought some additional assets to increase the sales from the earlier years. So after the adjustments, the arm's length price was the transaction price was considered to be within arm's length range. The tax authority wanted to apply CUP, because they wanted to see the reference from the commodity exchange, but could not appreciate the facts of the tax with the taxpayer, that this is difficult to implement because of the lack of consistent data, and the other product and the fact that the other product is not regulated. The selling price was the tax officer believed that the selling price, because of the fact that the selling price is determined by the head office or outside of Indonesia, and the fact that the pricing arrangement involved the payment on the basis of the exchange price less a fixed number, CPM should be applied, because they consider these goods as semi-finished goods just because of the fact that entire contract manufacturing is sold to the parent entity. Now, in the assessment, we showcase to the tax office that the CPM cannot be applied because of the fact that the databases do not provide the information at the gross profit level easily. We found that there were cases that certain expenses like depreciation was considered as cost of goods sold in certain companies. Some companies considered it in the operating expenses, and within the company in 1 year they have the assets but they don't claim depreciation in the COGS, and in some year they consider in the operating expenses. So there was a lot of inflexible policy, and that given that way, it's very difficult to apply the CPM. And we quoted the OECD, and OECD also supports our case and says that usually that semi-finished goods are to be seen from the perspective of the delivery from the taxpayer, not from the perspective of the end use. In this case, the product was used by the customer as an assembly, and use that to make the ultimate sale. But the sale that the captive sale that is made to the group company is sold as it is, though it is semi-finished, but it was sold to on a B2B basis to the customers. OECD also supports that CPM cannot be applied, and in case of semi-finished goods, unless there is a joint facility arrangement, it is not easy to apply the CPM. And you can this is more of a case where you can consider the overall expenses, and that should be the right way. So basis this, we face this challenge, and we argued, and the tax officer agreed that the TNM should be applied because of the lack of data. And this is, I'm sure, those who have worked on the transfer pricing issues would note that it is very difficult to find data at the gross profit level because of the inconsistent accounting policies, and the accounting standards also do not mandate the recording of certain expenses in the COGS and in the operating expenses. So the key takeaways we found in this case was that documentation should be robust, and there should be reason. I mean, as a classic case, you should always look at applying the traditional methods first because they are more direct methods. But in case those are not applicable, you should discuss that why particular methods like cup, cup resale price method, or cost plus method is not applicable to the facts of the case. We have seen in practice that some clients or their consultants are not showcasing, they're simply applying the TNMM, which sometimes is prone to be misused, and the tax officer may not clearly understand why this method is not considered. And detailed product life cycle needs to be explained well in the documentation, like this case, that though it is not sold to the direct consumer, but it remains a finished good for the business, though it may be used further before selling to the ultimate customers. Then on the case for a loss-making company, here we dealt with a company who's contract manufacturer and sells to third parties, and the company prepares an ex-ante documentation as as applicable in Indonesian regulations, and they expected a cost plus 3% as a reasonable profit. At the year end, the company faced losses, but as we followed the right practice, we tested the assumptions in the budget and the numbers in the budget, and showed the deviations on account of volume, on account of efficiency, or extraneous factors. Based on that, we were able to say that the budgeted ALP is in correlation to the actual ALP, and thus the transaction should be considered at arm's length because there are reasons for not meeting the budget. The tax authority denied the application of ex ante analysis, and also considered that the external and commercial factors, these are routine, and they cannot be adjusted. They cannot be adjusted to compute the arm's length price. And if the company is facing losses year on year, they should make it as a practice to consider those costs for charging back to the related parties. And the fact that the company to whom they sell is present in a low tax country, so this is a considerable tax leakage which the tax officer felt. But as I said, if we start correct, then it is easier to prove. So when we started, so at the tax office level, we could not. The tax officer could not get convinced, but at the appeal stage, we were able to showcase that the policy was always in order. There was reason for ex ante analysis and how the budget estimates were provided, how the capacity utilization was estimated, and how the going concern of the company is intact despite making losses in most of the years, why the business is still in existence, and what are the steps that the company takes in order to mitigate the extraneous factors. We showed all the documentation, internal budget estimates, board meetings, and all those things. With these things, we were able to prove that making losses was not the intent of the business, and it's just an final result. And by proving that these have a bearing on the business, and the pricing of the company was always correct, we were able to justify our case well. So this is the key takeaway, that you should always try and see if you can make an ex ante analysis and then test it with the actual results that happen at the end of the year, and document every important circumstances that can be used later on at the time of tax audit. The last case is regarding a company in Indonesia who is selling to a customer but is relying on the related party in Netherlands for technical support as well as for marketing support. And they're able to showcase that how the technical support is actually used by the company in the business, and also the marketing support and the procurement support on how they are, we were able to showcase that how those resulted in cost savings for the business, and how this helped the company focus on the main business, and which also reflected in the business profits. So unlike, it's a very contentious issue on intragroup services on proving the benefit test, but by using these kind of analysis, one can squarely, justify that a service is intended, and it's within the commercial expediency of the business to, take those services and justify those services for the business purposes. With this, I think we move on to the second topic of the presentation, which is the COVID-19 implications on the manufacturers and distributors. And I'm sure that some of the participants are also grappling with, the reducing profits, or sometimes, even operating losses, and how they can, consider the application of COVID-19 to their business cases. One clear aspect is that if the COVID-19 impact is computed in the audited financial statement, it makes the job easy, because then you are able to squarely say that this is also audited by the auditor, and these are the specific additional or extraordinary costs that you faced on account of COVID. And with making those adjustments, you can prove the your pricing to be at arm's length. But I think most of the cases that we see in audit, it is very difficult to to make this kind of impacts, maybe because of the fact the companies were not prepared to face this pandemic. And And eventually there are some management estimates, but these facts do not get audited. But then the OECD provides some guidance in this regard. We'll discuss it through a case first, and then we'll go to the guidance. So in this case, again, the favorite example, Singapore, Indonesia. Singapore is the distributor. Sorry, I think the facts are different. So Singapore is the distributor company, and Indonesia is the manufacturing company. And the uh, the company in Indonesia is selling selling its production through Singapore to the independent customer, and is also, you know, procuring the goods on their own. In this case, the company was unable to utilize their capacity again due to COVID restrictions. There was there was delay in procurements, and but at the same time, on the customer side, there were some SLAs that the company could not breach, and due to which they had to face some extra freight cost. For example, in normal circumstances, if they were to procure some things on the basis of shipment, they had to procure it through air means. And similarly, on the sales side, they had to do it similarly to ensure that they are able to meet their orders on time. There was time in between that the labor was not at full capacity, so there were adjustments on those accounts, adjustments on account of COVID related spends. So everything bundled together, and then some overtime at the time. The people were in factory, so the overtime and all those costs proved extraneous and resulted in a lower profit. But then this is in addition to the otherwise less capacity that the company is able to operate at. Even without that, over the years, the company was not able to operate at full capacity. So there are two kinds of challenges that the company faced. And so in order to mitigate this, because there is in the routine transfer pricing, the search methodology does not allow you to select loss-making companies. And this is the trend that we have observed from the Indonesian tax authority, that if the weighted average of the last 3 years is resulting into a loss, then they don't accept these companies. But what happens if the company is making loss? Then if you apply this filter, then ultimately you will always be at non-arm's length price. So the reason for adjustments and proving and looking at alternative ways to showcase how we can prove, because in all means, all these are genuine expenses, and despite being a contract manufacturer, these are costs not related to the pricing risk. They are more related to the efficiency risk, which is not in the control of anywhere in the supply chain, and somewhere it has to be distributed based on who is handling and who is otherwise expected to handle those risks. So let's look at what the key guidance from OECD is in this regard. It says clearly that there is a potential approach to utilize in transfer price to compare budgeted or financial statements to those which are actually achieved, to approximate the impact of COVID-19 on revenue, cost, and margins. So the guidance is very broad. Basically, OECD is recommending through their COVID-19 guidance note that you can make any kind of adjustment to the extent you are able to showcase the reasonableness and how it has impacted the business, and how otherwise the business profits are not impacted by intercompany transactions. So for example, in this case, the SLA freight overtime costs had a bearing, and this is covered within this para. If the specific effects of COVID-19 on revenue, costs, and margins can be identified, then you should be able to make those adjustments. The key again is, on the importance of ex ante analysis. I mean, in practice, we have seen that not many clients across Indonesia follows ex ante basis, but ex ante besides, as I mentioned earlier in this slide, has many advantages that you can, if you're confident about your pricing policy and the way you set your budgets are very logical, then it is recommended that the company should follow an ex ante basis and then starts documenting the reasons or logics for not achieving those budgets. I mean, this is very simple practice, and even in entire practice, like our practice also, we follow budgets and then we try to achieve that number. And if we don't achieve that number, we try to showcase what went wrong. And similar is the case with entire business. So these things are helpful in proving the impact of COVID-19. Similarly, again, they say that there, besides the other adjustments, one should also look at contemporaneous uncontrolled transactions to see, whether these can be used to prove your arm's length price. So is it suggesting that you should use a single year data? Yeah, I mean, why not? I think this is quite logical that you can instead of following the 3-year approach, you can see if your company is comparable to the single year data available. Now you may not have the data as on 30th April to check for the current year. Maybe then you have to look at, let's say, for those cases 1 year back, if that is also impacted by COVID, like for 2020 2021, whose due date was on 30th April 2022, you could look at 2021 information to see if your results are at arm's length. And again, there is another important guidance that we noted, that if there are differing reasons which you observe year on year and which you can relate to COVID, and then you can use these principles to showcase that these have a bearing. For example, you selected a benchmark on an ex ante basis, and COVID struck and you could not meet that data, and in your ex ante analysis you selected some comparables. You can see how those comparables also did in the same year as yours, and if they are also making negative margins, then it's also one of the interpretations of OECD as per us, that that you can use to say that
Check. Halo. Halo.
Masuk, Pak.
Oke, Pak.
Salil, I think we lost Salil.
At RSM, we have over 40,000 great minds that take the time to find out what makes you and your business tick. Our audit, Tax and consulting services are designed to help you move forward with confidence. But it's how we do it that sets us apart.
I'm sorry.
RSM's experts take time to understand what matters
Sorry, I think,
most to
I
you,
lost my
which means
network.
you receive advice that goes beyond.
Yeah. Yeah, sorry. I think I completed on COVID-19. Then I was discussing that this was the context of manufacturer. We have seen the OECD has even appreciated that even if you are operating as a limited risk distributor, even in those cases, unlike routine cases, you could also be participant to the risk because of the pandemic circumstances that is brought in. So I think in the interest of time, just quickly take up on the last topic, which is the revisions in the OECD 2022 guidelines. So basically, this is, in these guidelines, it's more or less the previous guidelines, but the addition of the three separate reports, one on the profit split method application, and then the hard to value intangibles, on how do you value the hard to value intangibles, and lastly on the financial transactions. So the guidance on these have been released in the last 4 or 5 years, and these have been formally introduced in the OECD guidelines to give it more pronouncement. So I'll just quickly, in the interest of time, spend 2-3 minutes on this. So largely this was always there. I think the profit split method, there is a very detailed guideline with 16 examples on which cases the profit split method can be used and how it can be applied. Because with the flow of information and data that is available, and the kind of with the advent of technology, the amount of knowledge sharing, the cooperation between the businesses is rising. There is joint development of intangibles taking place throughout the world. And in one case where you have a marketing intangible, in another country you have a technology intangible, and sometimes you are using jointly together to make the ultimate business sales. So in order to appreciate all these things, the profit split method will hold handy. It says that in 5 cases you can apply the profit split method, where you have unique and valuable contributions contributed by 2 parties. Unique and valuable intangibles are used in both the parties when in their business operations. Then separate assumption of closely related risks are observed between both the parties or more than 2 parties. And then the highly integrated business operations are found in practice. And lastly, this is the new, this was not there earlier in that detail, shared assumption of economic significant risk. For example, if let's say the designs and manufacturing processes are jointly developed in 2 countries. Let's say one is doing, like in our other case, semi-finished goods are produced and the design of molds are jointly contributed, then this could be a fit case for a profit split method. Then there is a guidance on hard to value intangibles. It says that, because this is extremely important in today's scenario, that because there is a lot of merger and acquisitions are also becoming a very prominent activity. So in the age of startups, there are businesses who are establishing technology, and there are times in between that without completing the ultimate product, they sell the partly developed intangible, and the valuation is a big challenge, as you would have seen all across the world, that how these companies are deriving values. So it could be technology intangible, it could be related to other intangibles. If let's say in a pharmaceutical industry, there are the company has already availed phase 1 and phase 2 approvals, and before availing the phase 3, they have sold the the intangible to Indonesia, and who is using that technology to ultimately sell the manufactured products. How do you assess the arm's length price for these kind of scenarios? There was earlier no guidance in this regard. OECD suggests that in this case you have to necessarily go for a ex post analysis. They say that you should look at the ex ante analysis before the before the transfer on how the business revenues were coming, what the projections were, and how the actual because when you sell an asset or when you value, you always look at your projected revenues. So this is a very practical guidance that has been shared, that you use that valuation analysis, the the profits that you expected, and then you use it to test later with the actual results when the sales are made to the ultimate customers. And if this is in line, then this should be considered as arm's length. The way the assumptions regarding those are framed, this should be considered at arm's length. But if it leads to higher numbers, then they can accordingly adjust. So this is the way the arm's length price can be derived as one of the ways. So it's a detailed document. I just wanted to give you a glimpse of how these guidelines are solving today's problem in complicated business scenarios or interlinked transactions. Then lastly, they have shared some guidance on financial transactions. So they have again practically implemented, because there are structures observed in the past 2 decades where companies are using Mauritius and other routes to fund their investments, and sometimes they are only and they're not doing enough activity to operate as a pure lender or a shareholder. So in this regard, the guidance is given that, for example, if Singapore extends a loan to Indonesia and the value of loan is 100 million, but Indonesia has, in its independent capacity, was not somebody who would have availed a loan of 40 million in the local market, then how do you assess the transaction? So in this case, one of the alternatives that the guidance note has given is that you should look at in third-party scenarios what would have been the maximum value of loan that would have been availed by Indonesia independently on the basis of their credit rating, and that should be considered as the value of loan. And the rest of the value in this example, 60 million, will be considered as an equity, and accordingly this will be up for consideration as a dividend flow. So whatever interest that is paid on the differential 60 million will be disregarded and could be recharacterized as an equity payment. I think that's it for my presentation. I think I would be happy to have any questions. Go on.
Thank you, Salil, for the presentation and share with us the recent TP audit trends, including 5 cases plus COVID impact and TP or OECD TP latest updates. So because I think we have here already Bu Melani, so put on hold the question. But so far we have only a few questions, so we'll wait until later. I would like to welcome Ibu Melani. Halo Ibu Melani.
Hi Juan, am I audible?
Yeah, Bu.
Wait.
Can you speak louder, Bu?
Yeah. Is it louder now? Is it louder now?
Belum terlalu, Bu.
Wait. Speakernya, I've already put the speaker closer.
Yeah.
Is it better?
Yeah, better, Bu.
Yeah. Okay.
Okay. Once again, thank you, Ibu Melani. Aside your very tight schedule, then we are privileged to have you here. So, Ibu, as mentioned, Ibu Melani is international tax analyst within BKF, the international tax analyst within BKF Ministry of Finance, and I think we know already Bu Melani prior to working with BKF. She spent some time within and she received her Master of International Tax from University of Sydney. Ibu Melani will cover three part of the international tax update. The first one is Pillar 1 and Pillar 2. The second one is in Indonesia's international tax reform. Sorry, two parts. And for those of you who probably needs an update on what is Pillar 1 and Pillar 2. So Pillar 1 is basically it is a profit allocation and nexus. This is as a follow-up of taxing the digital economy initiative. So it aligns taxing rights more closely with local market engagement. So it is very relevant for Indonesia, and we need to also hear latest update both at the global data or at the OECD inclusive frameworks, and also what is Indonesia doing to anticipate this application. Whilst Pillar 2, it is about global minimum taxation. So it basically establishes a global minimum taxation regime, series of interlocking rules, which I think Ibu Melani will cover this as well. There are some issues for both initiative, Pillar 1 and Pillar 2. I think this is more on the timing, and I think most of jurisdiction, they have their own position. So it is a bit difficult, I think, for OECD and G20 to manage. So that is why I think suppose if they have reached the agreement, and hopefully this can be finalized by this year and will take effect during, I think, suppose in 2023, but we need to listen also from Ibu Melani, what is the latest position of this development. Without further ado, Bu Melani will hand over to you.
Thank you, Pak Iwan. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, everyone. Let me share my slide. Okay. As Pak Iwan has mentioned before, actually I don't have to introduce myself anymore. My name is Melani Dewi Astuti. I will present two topics today, as Pak Iwan has mentioned, the two-pillar solution and the Indonesia's international tax reform. So to save our time, I'd like to start my presentation. As we know that OECD and G20 have worked together to develop a two-pillar solution to address the tax challenges arising from the digitalization of the economy. By the end of 2021, 137 countries, the member of BEPS Inclusive Framework, out of 141, have joined the global agreement. The October statement has been released by those BEPS EF members. For Pillar 1, the work is still ongoing, but a progress report on Pillar 1 has been published on July 2022. Almost the same as the G20 Indonesia presidency meeting on July as well. And about the Pillar 2, the work is more advanced. The commentary, the model rules have already been published in early 2022 and is ready to be implemented through domestic law of each countries. Now I will go more detail on each pillar. Pillar 1 is aimed to reallocate taxing rights to market jurisdiction. Sorry, okay. I hope I am audible. Reallocate taxing rights to market jurisdiction under Amount A, irrespective the existence of physical presence. As we know, under the current rules, the market jurisdiction cannot tax the profit of foreign resident in the absence of physical presence or permanent establishment. Pillar 1 also introduced a new nexus, which is not relying on physical presence, but significant economic presence in the form of sales. And it also introduced a new profit allocation rule, which is not based on arm's length principle, as my colleague Salil has presented before, but it is relying on the certain formula, which is so-called amount A. Pillar 1 also introduced an additional mechanism for tax certainty specifically for Pillar 1. Meanwhile, Pillar 2 is aimed to address the remaining BEPS issues and also aim to end the competition of corporate tax rate. Pillar 2 will introduce a global minimum tax of 15% to ensure that large MNEs will pay tax minimum of 15% wherever they operate. Pillar 2 consists of two. The first is two interlocking domestic rules, which is GLOBE rules, contains IIR, income inclusion rules, and under tax payment rules. And the other is the treaty-based rule, which is subject to tax rules. Now I will go more detail on each pillar. Pillar 1. The scope of Pillar 1 is MNE with global turnover more than 20 billion euro and profitability threshold above 10%. So it is accumulative. This both thresholds should be satisfied so that an MNE will be in scope of Pillar 1. The extractive industries and regulated financial services are excluded. Revenue sourcing is needed to identify the market jurisdiction. There will be different revenue sourcing rules for different type of income. For example, with regards to advertising, the revenue sourcing rules is where the location of the viewer, not the person who pay for the advertisement, but the viewer. And the indicators could be for example, the IP address, billing address, and etc. And then special purpose nexus, as I mentioned before, the nexus is sales, not a physical presence. In scope, MNE derives at least 1 million euro in revenue from market jurisdiction. That's the new nexus, especially for amount A only. For smaller jurisdiction with GDP lower than 40 billion euros, the nexus will be reduced to 250,000 euros, but Indonesia is not included in the smaller jurisdiction. And the profit allocation, this is a new formula for amount A, is the 25% of residual profit or profit in excess of 10% of revenue or return on sales allocated to market jurisdiction based on revenue as an allocation key. So if we already find the nexus based on the revenue sourcing, and then we know whether the nexus purpose is met or not, is if the revenue, if the nexus is met, then the market jurisdiction will get the share of amount A, which is 25% of the residual profit. And as I mentioned before, the countries who already joined the global agreement has already made together a statement on October. Based on the October statement, all countries commit to remove of all of the digital service tax and other relevant similar measures with respect to all companies. For example, like equalization levy and others, they are similar, and for all companies. So it's not acceptable for a country to impose digital service tax for companies out of scope of Pillar 1, because it's not allowed under the October statement. Pillar 1 also introduced amount B. Well, this is not a new profit allocation rules. It's just a simplification of the arm's length principle with regards to baseline marketing distribution activities. So it's like we will have a set of benchmark to simplify the application of arm's length principle. The work on Amount B will be finalized by the end of 2022. Pillar 1 will be implemented through a multilateral convention, which previously was targeted to be signed on July 2022. But for some reasons, the first is because the work on Pillar 1 has not been finalized yet. There were still some outstanding issues not being agreed and not finished. And then the second reason may be because the US could not sign the MLC this year because of the political situation in US. Therefore, the signing is postponed to half of 2023, and it will be enter into force on 2024. Next, well, actually, Pillar 1 indeed could add additional revenue for market jurisdiction, which is not possible under the previous under the current rules in the absence of physical presence. However, there will be some issues about, for example, marketing distribution safe harbor and the elimination of double tax, because they might reduce the profit share to market jurisdiction. And the scope itself, it only scope largest and most profitable M&E. So it will be possible for digital businesses having significant sales in Indonesia, but not in scope of Pillar 1. So we cannot impose digital tax to that company. Okay, next. Now I will present about Pillar 2. As I mentioned before, Pillar 2 consists of two. The first is STTR. The first mean in the hierarchical order, STTR will be applied in the first. STTR will allow source jurisdiction to impose limited source taxation on certain payments, for example, interest, royalty, and certain service fee made to connected person. Connected person is it's like the definition of closely related person in the Article 5 of the new DTA modified by MLI, which subject to low rates of taxation in the resident country. The minimum rate of STTR is 9%. The STTR will be creditable as a covered tax under the GloBE rules. The STTR, as it is a treaty-based rule, it should be incorporated within the DTA. Therefore, a multilateral instrument is necessary to modify the current tax treaty. And then the GloBE rules. First, the IIR will allow resident country to impose top-up tax on a parent entity in respect of the low tax income of a constituent entity. The top-up tax itself is the difference between 15% and the ETR of the constituent entity in a jurisdiction. And then the undertax payment rules will allow resident country of the subsidiary to deny deduction or make equivalent adjustment equal to the amount of top-up tax under IIR. However, the UTPR can only be implemented if IIR cannot be applied. The implementation of UTPR will be postponed until 2024. Both rules, the GloBE rules, should be implemented in the domestic law. So we don't need a multilateral convention or multilateral instrument to apply GloBE rules. And the rates is 15%. Accordingly, there is a consequence or a risk that other countries may apply GloBE rules ahead of Pillar 1 without STTR, because the work on the work on GloBE rules, the model rules, had been published. So countries could incorporate the model rules in each domestic law. So there is possibility that GloBE rules will be applied earlier than Pillar 1. So there will be a consequence for developing countries. I will explain later. Now I will go more detail about Pillar 2. The scope of Pillar 2, it targets large MNEs with consolidated turnover at least 750 million euros, with the exemption on the government entities, international organization, non-profit organization, pension fund or investment funds, as well as international shipping income. As I mentioned before, the rule order is STTR, and then IIR, and the last UTPR. UTPR will only be applied if IIR cannot be applied. And the ETR computation based on jurisdictional ETR. So if there are many constituent entities in a jurisdiction, the calculation of the ETR will be aggregated. And then we have substance-based exclusion to exclude portion of income from the globe income. The substance-based exclusion is 5% of the carrying value of tangible assets and payroll. There will be a transition period of 10 years. And the implementation, as mentioned before, the globe rules will be implemented through a domestic law. And the STTR will be implemented through a multilateral instrument, but the draft of the MLI is still being developed. It's not finished yet, but the globe rules is already finished and ready to be implemented. Some countries have already put the model rules into their domestic law and go to the parliament. So we'll see whether next year some countries maybe already implement globe rules. Well, there are some impacts for developing countries with regards to Pillar 2. First, Indonesia might get additional revenue, for example, on the application of IIR and STTR, and maybe also UTPR, even though it is very limited. However, for the IIR, it seems that the revenue is greater for developed countries because the parent entity is mostly domiciled in the developed countries. And the second, the Pillar 2 might bring impact for the effectiveness of the tax incentive. This is because the tax incentive that resulted in an effective tax rate below 15%, the tax saving will not be enjoyed by the investor, but the resident country of the parent. So if, for example, if Indonesia provides tax holiday, so the ETR is 0, the resident country of the parent might impose top-up tax 15% minus 0 equals to 15%. Under the current rules, before the implementation of Pillar 2, the 15% is enjoyed by the investor. However, the developing countries might have challenges due to the implementation of Pillar 2 because the countries tend to reduce their corporate tax rate, and it could be a competition of the CIT rate. And second, most developing countries relying heavily on CIT income, not to mention Indonesia. And lastly, many developing countries provide generous tax incentive to attract FDI. But there is also opportunity for developing countries due to the implementation of Pillar 2. First, there will be less pressure for developing countries to provide tax incentive resulting ETR below 15% to attract FDI. Thus, it will be additional revenue for developing countries. I don't know for the investor, because if we don't tax, the parent country, the country of the parent will tax. So the investor will not get the 15%. They only get the difference between the domestic corporate income tax rate minus the 15%. in the case of Indonesia, the investor will only get 7%, 22% minus 15%. And if there is a substance-based income exclusion, that's the only tax saving that the investor might get. Second, the inclusion of qualified domestic minimum top-up tax to preserve Indonesia's taxation to avoid the imposition of top-up tax under IIR. So under the GloBE mechanism, the qualified domestic minimum top-up tax will reduce the amount of the GloBE income that will be taxed under IIR. So under the market jurisdiction, the jurisdiction of the subsidiaries or the constituent entities might impose QDMTT in order to preserve the right to tax until 15%, so that the tax do not go to the resident country. Third, whether Indonesia will apply QDMTT or not, let's see. The third, developing countries could now rely on non-tax factors. For example, enhance its ease of doing business to increase competitiveness or to attract FDI. Because now it's not effective to provide tax incentive which resulting in an effective tax rate below 15%. That's about Pillar 2. Now I will move to Indonesia's international tax reform. Well, actually, this reform is reflected in the law number 7, the Harmonization of tax law. There are so many changes and so many new provisions within the law. I will explain one by one. The first, maybe it's not in the law number 7, but it's in the job creation law. It's the changes related to the definition of Indonesian national who stays outside Indonesia for more than 183 days and qualify certain requirements. What is certain requirements? They are first, having permanent home in a place outside Indonesia. Second, having center of vital interest outside Indonesia. Third, having habitual abode outside Indonesia. Fourth, becoming a resident of other country, which is proven by a certificate of resident issued by other country. And last, the other requirements such as having fulfilled the obligation to pay tax while the resident is in Indonesia. Well, maybe you remember that this criteria is similar to the tiebreaker rule of the individual within the tax treaty. Yes, it is similar, but there might be some difference. We don't use the nationality tiebreaker rule. Now I will explain about the territorial tax system in Indonesia. After we issue a job creation law, we move from worldwide tax system into territorial tax system by exempting some foreign income. The first is exemption of income tax on foreign dividend and profit after tax of a PE, permanent establishment. The second, income tax exemption on foreign income earned not through a permanent establishment. And the last, exemption on foreign income of an expatriate, qualified expatriate. The objective of the shifting is, first, to eliminate double taxation. Second, to stimulate repatriation of income because we have a requirement of minimum 30% to be invested in Indonesia. Third, to encourage outbound investment because we don't require all of the profit, the foreign income, to be invested in Indonesia. Just 30% of the profit after tax, not all. So the rest of the 70% could still be put outside Indonesia to be invested in foreign countries. And lastly, to encourage technology and knowledge transfers. This is the requirement for the expatriate regime. And now I will go more detail to each exemption. First, exemption of income tax on foreign dividend. The scope is the dividend received by corporate and individual, dividend from publicly listed company and non-listed company, and the dividend should be derived from profit after tax booked in 2020 and received from 2 November 2020. There is differences between dividend from listed company and dividend from non-listed company. The exemption on dividend from listed company apply if dividend invested in Indonesia is less than the amount of dividend received. Only dividend invested in Indonesia is exempted. The portion that is not invested in Indonesia will be taxable. Meanwhile, the dividend from non-listed company, the full income tax exemption on profit after tax is provided. The full exemption of the profit after tax is provided if the dividend is invested in Indonesia at least 30% of profit after tax. If the dividend invested in Indonesia is less than 30% of profit after tax, the exemption is provided for the amount of invested dividend and the 70% profit after tax. So you don't need to bring all the profit after tax to Indonesia to get the full exemption. Just bring minimum of 30%, you get full exemption. And the difference between 30% profit after tax minus the invested dividend will be taxed in Indonesia. Let's say if you only bring 2%, you will get the exemption on 2% plus 70%. The 28% will be taxable. I hope it's already clear. And next, the income tax exemption on income after tax of a PE owned in foreign countries. The income will be exempted from income tax if it is invested or used to support other business activities in Indonesia for a certain period. The exemption mechanism is similar to that of non-listed companies. As you remember previously, dividend which uses 30% profit after tax threshold on investment. So the same as, wait a minute, yeah, as this one, dividend from non-listed company. You just need to put your profit after tax minimum 30% and you get full exemption. And then the income tax exemption for foreign income earned not through a PE. Foreign income earned not through a PE is income from abroad which derives from activities or business conducted in foreign countries. For example, if Indonesian companies sells to countrywide customers through independent distributor, this will included in this type of income. So if the income is brought to Indonesia or invested in Indonesia, it will be exempted. The income will be exempted from income tax if it is invested or used to support other business activities in Indonesia for a certain period, provided that the income derives from active business performed abroad, selling goods, provision of services through maybe independent distributor or through employee perform in a foreign country, but not exceed the time test within the DTA. And B, not income of subsidiary owned abroad, because this will be covered in the previous type of income, dividend. Income tax exemption is only provided for the amount of income received that is invested in Indonesia. The amount that is not invested in Indonesia will still be taxable. This is the investment requirement, the investment form, and the investment period. The period is minimum 3 years. So the fiscal year X plus 2. And the form of its investment is various. It's so easy to be met. It could be in the form of government bonds or investment in domestic bank or investment in a real sector and etc. as you can see in the slide. The taxpayer shall make investment realization report and it must be performed annually no later than first and of third month after the year of investment for individual and end of fourth month after the year of investment for corporates. Okay, next. This is the expatriate regime. So it will be applicable for foreign national who becomes an Indonesian resident for tax purpose, who has certain expertise and meets certain criteria and occupied certain position or researchers as prescribed by the relevant ministry. If the expatriate satisfy the requirement, the territorial taxation applies for 4 fiscal years since becoming Indonesian resident. And the criteria is, first, he must be a foreign national. He must have expertise in the area of science, technology, and mathematics. And it can be proven from the certificate of expertise, graduation certificate, and working experience minimum of 5 years. And the last criteria is he shall perform technology or knowledge transfer. Qualified expatriate will only be taxed on income source in Indonesia. It could be applicable by request. The inward expatriate regime could not be applied if the expatriate choose to apply the DTA between Indonesia and the country where he receives the income. This is the list of the expertise that qualify for the expatriate regime. Okay, next. It's the other facility provided in the previous law, Government Regulation number 9. So the tax rate on the interest on bond is reduced from 20% to 10%. If you remember, the majority of interest rate in Indonesian DTA is also 10%. Accordingly, you don't need to present the DGT form in order to apply 10% rate, as provided that the rate is similar to the rate within the DTA. But if the treaty rate is lower than 10% and you want to apply the treaty rate, you still have to present the DGT form to DGT. Well, next is the domestic anti-avoidance rules as circulated in the Article 18 Income Tax Law as already modified by Law number 7. I will explain one by one. The first is about the interest deduction rules. The substance of the changes is giving authority for the Ministry of Finance to determine the limitation on the deduction of borrowing costs for the purpose of calculating income tax in accordance with the law. If you remember, the previous rule only give an authority to the Ministry of Finance to determine the ratio between debt and equity. So it's not possible for the DGT to apply other measures to limit the deduction of the borrowing cost other than thin capitalization rules or debt to equity rules. Under the current regulation, it is 4:1. However, under the law number 7, now the government, the DGT could apply other method other than debt to equity ratio. For example, using interest to EBITDA to limit the deduction of borrowing costs. Next, just wait, we still design the new rule about the interest deduction rule. Next is about the transfer pricing rules. There are some changes within the arm's length principle, the implementation of arm's length principle in the Article 18, paragraph 3. The first change is about the transfer pricing methods. The second is the benchmarking for taxpayer who reports losses for who already operate commercially for 5 years. And the last is secondary adjustment. The changes related to the method. So if we see the new rule encouraged to use other method, and now the elucidation of the Article 18, paragraph 3, the law number 7, provide more detailed explanation. If we see, the main method used is one, comparable uncontrolled price method, or CUP. The second is resale price method. And last is cost plus method or other methods such as profit split, TNMM, and CUT, tangible asset and intangible asset valuation, and business valuation. If we remember, the previous regulation do not have the room, the DGT doesn't have the room to apply other method other than profit split and TNMM. However, under the new rule, DGT could apply other method other than 5 OECD method. For example, like CUT, tangible asset and intangible asset valuation, and business valuation. The purpose, of course, to accommodate the use of other methods other than 5 OECD method. Now it's about secondary adjustment. The new rule, the Article 8, paragraph 3, under the law number 7, has provided an authority for the DGT to perform a secondary adjustment for a transaction that is not arm's length. It will be regarded as dividend that is subject to income tax according to the tax laws. So maybe it doesn't have to be dividend distributed to the shareholders. It could be dividend distributed for the affiliates. It will be regarded as indirectly distribution of dividend. This about the benchmarking, as I mentioned before. We have new elucidation of Article 18, paragraph 3, the law number 7. It says that the taxpayer structures its tax avoidance by way of reporting income lower than the actual amount, reporting expense higher than the actual amount, reporting profit way too low compared to that of other taxpayers in the similar industries, or reporting non-arm's length losses, although the taxpayers have operated commercially for 5 years. So in this regard, DGT has an authority to reassess the amount of income and or expenses in accordance with the arm's length principle. For taxpayers who reports profit which is too low compared to that of other taxpayers in the similar industry sector, or reports non-arm's length losses, although the taxpayer have operated commercially for 5 years, benchmarking can be applied. Of course, benchmarking based on the financial performance of taxpayer in similar business activities. And lastly, it's about international agreement. The purpose of the changes is to provide legal basis for the government to sign and implement an international agreement other than tax treaty. And second, to provide legal basis to sign MLC under Pillar 1, MLI under STTR, pursuant to two-pillar solution and to implement two-pillar solution. And then the new rule describe types of international agreement that currently Indonesia have. And the law number 7 also changed the rules on the MAP. The purpose of the changes, first, to provide legal basis for MAP in the domestic law, which is law number 7. Second, to provide simplicity to taxpayer pursuant to MAP request. Third, to accommodate BEPS 14 recommendation. Fourth, to provide legal basis to implement MAP agreement. And lastly, to provide clearer interaction between MAP and domestic remedies. The significant substance of the changes, so the taxpayer could apply for MAP and domestic remedies simultaneously. But if the MAP hasn't produced an agreement while the tax court has announced its verdict, DGT first continue the MAP if the dispute settled in the court is not the one that taxpayer apply for MAP. Second, referring to the court's verdict as the MAP position or stop the MAP consultation if the dispute settled in the court is the one that taxpayer apply for MAP. So this is new to provide solution for the this become a problem before. And the second, the main changes, DGT will publish notice of assessment to implement MAP result. Such a notice of assessment is a basis for refund or tax collection. And the law number 7 also include the assistant in collection provision. The purpose of the changes is to provide legal basis for the provision of assistant in collection in reciprocal basis, and second, to encourage active collection of tax. So now the Ministry of Finance has an authority to cooperate with other countries based on international agreement with regards to assistant in collection. And then the provision of assistant collection will be performed in a reciprocal basis, and the collection of tax will be performed in accordance with the laws. I think that's all. Thank you very much. I'm ready for having further discussion with you. Thank you.
Thank you, Ibu Melani. The slides cover a lot of issues, and I will be extremely apologize because this is the time allocation is only maximum for 30 minutes, but we can continue the discussion if any participants here still have any questions. But prior to allowing the participants to go through or to take notes on your presentation, we do have some questions. First to my colleague Salil. Then hopefully this is because the issues here is more practical because no new transfer pricing regulation issued recently other than the one that explained by. So I'm quite because this is our also personal experience dealing with the TP audit or represent the clients in the tax court. So Salil, in relation to the segmentation, so do you see that because I think it is not clearly mentioned in any regulation, both in OECD or in domestic tax regulation, how do we normally take the position? Because the tax office seems to consider that segmentation is not allowed if, say, for example, this is not in relation to the company itself has no different function. So it's only one function to serve the same clients with the same services, so no segmentation is allowed. The impact to the bottom line, to the profit level indicator is quite significant. So what do you how do you observe this situation?
All right. Thanks, Pagikwan. I think this is the as I explained in the slide, the tax officers are taking the positions based on the based on their understanding of the cases, and which we observe is giving a favorable result. As I said, the OECD in the para that I reflected in the presentation, it says that the ideal position from an OECD overall from a transfer pricing perspective is that we should segregate the transactions to the highest possible extent so that we can look at each transaction separately. Now, if the materiality of the transaction is low, then you can consider aggregating it. But usually the recommendation from OECD is to segregate the transactions to the extent possible. And within, if you have one transaction with related party and non-related party, there is a guidance that to the extent it is possible, you should be able to segregate it. Now, in real life, what we have seen is usually there are the segmentations involve both direct and indirect cost. Now, direct cost can be mapped through the ERP solutions, and which should be reliably accepted by the tax office. But the indirect costs are difficult to prove, and this is also another point that how do you segment, because in practice we have seen not only in companies or in fact which is right also, not only you can attribute on the basis of costs and sales, but you can also attribute expenses or segment your expenses on the basis of, let's say, number of employees, the space per square feet, and various other considerations, which is more reflective of the ideal situation. Like, for example, when we buy an apartment, we pay as per square feet. So everywhere, the considerations, if let's say the company is willing, if company is renting or joint renting space is taken, then if one company and one related entity is occupying that space, it's pretty fair that you can consider per seat cost allocation or any other basis. So it's a very practical scenario, and this is how it should be observed. But yeah, I mean, in reality, you have to look at materiality and other considerations also.
Yeah, I think that also the issues that I would expect become more and more dispute raised by the tax office, and I think within our team we have some the expert, including Salil and also some others with who will be ready to serve the client needs.
Can I add something?
Yeah, sure. Okay. Yeah.
Well, actually, what is done by the audit cannot be. I mean, he is based on the regulation, Ministry of Finance regulation number 213. Yeah. It says that segmentation shall be done if the taxpayer has more than one function. But it doesn't mean that segmentation is not allowed in other conditions.
Yeah.
However, maybe
well, that is the issues. So the way that the tax auditor considers, if no separate or more than one function, then you are not allowed to use segmentation.
And which is a little inconsistent from the accounting principles, because in the accounting standard it says you can do it as per geography, you can do it as per products, but it does not speak about
correct.
Yeah. Correct. And I agree with Salil that in the MOF number 230 also said that the transfer pricing should be done transaction by transaction. So if we do that, if we do this, segmentation might be needed, even though the function is not more than one.
Yeah, and I think it is also consistent with the approach adopted by OECD guidelines, that if you have revenue and costs associated with the non-affiliate, and that those should be excluded. Okay, yeah, Salil, I think we have limited time and we'll move to Ibu Melani. Ibu Melani, the question on pillar one, your slides, I think discuss amount A, and the last point on unilateral measure. One of the point is basically it is intended by the OECD or G20. They decided or they agreed to remove all digital services tax and other relevant similar measure with respect to all companies. And that this links to the Indonesian regulation, the law number 2 in I think Article 6. So the government decided to impose to the direct tax and the indirect tax. For the indirect tax, I think that has been running, no issues. But for income tax, the direct tax, they divided it into two situations. So if it is deemed as a BUT, then government can impose tax. But the different scenario, if, say, for example, we cannot, or GT cannot deem any PE exists because of the tax treaty, and they may impose transactional tax, electronic transaction tax, which is, I think, it is also consistent with these periods. Are you saying that, or do you agree that this will also part of this unilateral measure that Indonesia cannot impose tax on this? Masih mute, Bu.
Yeah, thank you, Pak Ivan, for the question. Yes, it is Indonesian unilateral measures. However, we haven't implemented yet.
Yeah.
To appreciate or to commit because we have joined the global agreement on October 2021, on July 2021. So the government haven't published the implementing regulation. Accordingly, the electronic transaction tax cannot be applied up to now. However, there is also a problem because based on the October statement, if by the end of December 2023, critical mass is not met, critical mass could be means that the most impacted countries agreed. It's of course US. Our countries will that mostly impacted or becoming relieving jurisdiction agreed. For example, like maybe the other developed countries having residual profit, so critical mass will be achieved. If by the end of 2023, critical mass doesn't meet, is not met, the unilateral measure can be applied. It will be back to status quo. However, we have a problem because the law number 2 is brought to Supreme Court for a judicial review.
Yeah.
And the verdict said that the law number 2 is a temporary law. It only addressed the COVID-19 situation. So if the COVID-19 is not an endemic, it is not a pandemic anymore, but it becomes endemic, for example, the law number 2 cannot be applied anymore. So the substance within the law number 2 will not be entering into effect. So what is the problem? Because electronic transaction tax is a new tax, it's not an income tax, it's not VAT or GST. So once the president has announced that the condition is not pandemic anymore, the law number 2 will be automatically not applied. So there is no more electronic transaction tax. So after 2023, if the critical mass is not met, the Indonesian government should design the new tax under the new law, because we cannot put the new tax within the income tax law because it is income tax law, nor the VAT law. That's our problem. Yeah, but we do not expect that will happen. We support the pillar solution to be implemented, because unilateral measures could bring disadvantages to taxpayers and could affect the investment. Thank you.
Okay, thank you, Bu. It's very clear. For those of you, Ibu Melani is not working within the DGT now, so the question should be at the policy level. So now
But I think it's okay, but I can
Okay.
answer the question.
Okay, okay, thank you, Bu.
Because even though I'm not in DGT, I also involved in the design of the tax regulations. But I could not inform now because it is not published yet.
Okay.
Just wait, because we need implementing regulation to apply two-pillar solution. But we have already put the legal basis in the law number 7 to give an authority for the Ministry of Finance to sign the MLC or MLI for STTR and implement the two-pillar solution. So that's enough. But for now, we cannot draft domestic law for the Pillar 1 because the work itself is not finished yet.
Okay, okay.
That's all.
Yeah, and the next question on Pillar 2, the global minimum tax. I think it is very interesting to follow also the recent development. So the question is more on the potential tax revenue foregone that may impact to developing countries in this case. As you mentioned, that 15% global minimum tax will apply, and we are aware some countries, in order to attract investment, they introduce kind of tax facilities, including tax holiday in this case. So, do you think that this is the, or what is your observation or recent discussion within the OECD? G20, that this tax incentive, tax holiday, or whatever facilities offer to reduce the corporate income tax, that this is the end of the tax incentive era, because then if no tax is paid in the source countries, for example, in Indonesia, because Indonesia also offer a tax holiday facilities, then basically this will become a tax revenue foregone for Indonesia, whilst the same amount, or probably more or less the same amount, will be enjoyed, those portion will be enjoyed by the resident countries to impose a tax under the global minimum tax. What do you think?
Well, OECD will not say that. They will say the Pillar 2 will provide less pressure for developing countries to provide tax incentive below 15%. And maybe I could say that actually the government doesn't lose the tax revenue, because by providing tax incentive, government is actually choose not to tax the income, but giving the tax to the investment. Now, by the implementation of Pillar 2, the tax saving could not be enjoyed by the investor, but the resident country. That is not the result that we expect by providing incentive. Therefore, some countries want to apply QDMTT. So the country of the subsidiary could still tax 15%. Instead of going to the resident country, the Indonesia could still impose 15% tax under the QDMTT. But I could not say that this is the end of tax incentive. Not all tax incentives will be highly impacted by Pillar 2. For example, the tax allowance, maybe it is impacted, but not as significant as tax holiday. And maybe the incentive based on substance, maybe it's not highly impacted because Pillar 2 has substance-based exclusion. If the incentives provided to business with high tangibles asset and high employee, so high payroll, maybe it will not be impacted highly. So it's not the end of tax incentive, but we cannot provide tax incentive that resulted in an ETR below 15%. So if we want to apply tax holiday, maybe it will not be 100 exemption. The exemption will be equal to the 15%. But yes, it have impacts on developing countries with regards to the effectiveness of tax incentive, especially incentive that resulted in an ETR below 15%. Thank you, Pak.
Okay, thank you, Bu. So there are two questions on the chat box. So the first one is, I think this is a very general, whether any KFK or government regulation issued to say to respond to Pillar 1. And the second one is this is BEPS question on BEPS 2.0. The Pillar 1 provides a big threshold. Then to what extent? The question is to what extent this will do in favor to Indonesia, since the threshold amount is quite high. I think those are the two questions. Yeah.
I think I have already answered the first
Yeah.
question, yeah.
Yeah.
Previously, Pak, that
yeah.
we still have to wait for the Pillar 1 to be finished entirely, and we will be able to put that in our domestic law. But for now, we have already the legal basis to, in the law number 7, to sign the MLC of Pillar 1 and MLI of STTR Pillar 2, and to implement both pillars. But to circulate the more detailed provision, it's not possible for Pillar 1. But for GLOBE rules, it is possible because the model rules was already published. And for the second question, yes, I agree that considering the high threshold for Pillar 1, Indonesia is still be able to get additional revenue, but it is limited because it might be only around 110 MNEs worldwide will be impacted by Pillar 1, and not all of them having sales in Indonesia. So there will be a situation that an MNE having significant sales but doesn't meet the threshold, the 20 billion euro and 10% profitability, because they sometimes having a big profit in Indonesia but doesn't meet the 20 billion euro threshold, or they have a significant global turnover, satisfy the 20 billion euro threshold, but the profit is below 10%. Yeah, so even though there is additional revenue, it could be limited because the scope is very, very limited, very largest and most profitable company.
Okay, yeah, thank you. Probably this is the last question on the Indonesia position or the latest regulation on international tax reform. So I'm quite interested to explore on the policy that has been discussing on nomad visa. So because that attract also or invites some professional to work and likely in Bali, and they may stay longer, then this will definitely attract their tax residency considered as Indonesian tax resident. Any insight on where the regulation is drafted now, or does this will also, do you think that this will also create another issues between the policy level and the, say, the audit level?
Well, I don't think there will be a new regulation on the definition of resident. So we already have the regulation on the definition of Indonesian resident and non-resident of Indonesia. And the law number, the job creation law has already changed the definition of non-resident to include Indonesian national who live in Indonesia less than 183 days. So he could be regarded as non-resident if he qualifies certain requirements, as I mentioned before. Well, for digital nomad, yeah, there are frequent cases in the period of COVID, especially many foreigners working from Bali. Well, it might create permanent establishment to some extent if the criteria of the PE is met. If, for example, if there is a fixed place to carry on business in Indonesia, in Bali, or if the foreigner provides services more than time test, there will be a PE for a service, or for a dependent agent. It is possible, but it is also possible for a foreigner establish a company outside Indonesia but working solely from Indonesia. He's the only owner. He's working remotely from Indonesia, so the entity could be Indonesian resident because it is managed and controlled from Indonesia. So there will be two possibilities: a PE will exist, or the entity will be regarded as an Indonesian resident. Thank you.
Okay, that is why the key issues here is if we invite and then we do not provide solution or mitigation for this, and then that will not be attractive to, say, invite digital nomad professional to come to Indonesia.
Well, we already have expatriate regime. If they eligible for the requirement, for the criteria that I present before, they will be eligible for territorial taxation. So their foreign income will not be taxed in Indonesia. But if they are not included in the list of expertise, they will still be taxed based on undang-undang Indonesian regulation or income tax law.
Okay. Thank you. And last, before I ask you to provide also probably last or concluding remarks, or if you have any concern, and I'll ask, there's one question, Salil, for you. This is the last one on the comparable companies, because I think it is more on the fact there is no standard, which one is or which comparables can be accepted by the tax authority, and even amongst the say tax firms, they may come up with different comparable companies. What do you think?
Okay. So I think it's a very relevant question, which in fact there is no certainty to this, because the way when the comparable companies are selected, I think most of the consulting companies, top companies, are using same database, but it goes through a subjectivity where, some companies, like we try to be close to the company's financial results. So we will use some ratios like the related to the sales, the special costs and other things to make it more comparable. the other consultants may not apply it because there is no universal principle. And at the end of the application of, the selection of the SIC codes, the quantitative filters that we are going to use, as well as the qualitative and manual selection, that is the end process that we use when we start looking at websites and the annual reports of the companies to the extent available. That's how the companies are selected. So the entire process is very subjective. So I think this will be very difficult that if two companies, let's say we and other companies doing benchmarking, they will come at same results. So it's definitely going to be different, and that's where the importance of transfer pricing documentation comes into place. That you have to ensure that whatever you are doing from the start to the end, including all the process, this should be well rationalized and documented so that it can be explained well in the proceedings.
Okay, yeah, and I think even if we are in agreement to come up with the same comparable companies, and there is no guarantee that the tax auditor will agree with your comparable companies, and in most cases, those are the major adjustment made by the tax audit.
Yeah, because the main principle is that the tax officer is ideally expected all around the world to accept the transfer pricing documentation, unless there are some gaps related to the estimations or the reasoning given. That's why the language, the quality of documentation needs to be really high.
Yeah. At the end, based on my experience, it is not only the document must be there, but at the end, it is about reasonableness of those documents itself. What numbers that can be accepted by the tax office. Ibu Melani, do you have any concluding remarks, or you want to also comment on that?
No, I think enough.
Okay.
It's a sensitive issue.
Yeah, I know. Okay. Salil, do you still have something to share?
No, I think all the points are very well explained. I think one point that you earlier discussed with Ibu Melani regarding the electronic tax. I am sensing from my experience of other parts where they have gone about implementation of those schemes. There are some overlaps observed with royalty also. So for example, certain transactions would be expected, the clients will be confused whether withholding tax related to royalties should be done or whether it is subject to digital service tax or electronic tax. These will also come as very, problematic situations, and that would be a recommendation that, if we can provide sufficient guidance, because this can really, create uncertainties in the minds of businesses.
Okay, thank you. And by having comments from both you and Ibu Melani, I think we can conclude this session. Again, thank you for your time. Thank you, Ibu Melani, for your for allocating time to us. And don't forget to fill in the feedback form, because those information, your email address will be used to by our team to share the slides. Okay, once again, thank you very much, and have a good day. Thank you, and see you.
Thank you, Melani.
Thank you.
Thank you.
Thank you, Pak Iwan.
Okay.
Thank you, everyone.
Thank you.
At RSM, we have over 40,000 great minds that take the time to find out what makes you and your business tick. Our audit, tax, and consulting services are designed to help you move forward with confidence, but it's how we do it that sets us apart. RSM's experts take time to understand what matters most to you, which means you receive advice that goes beyond your expectations. What you'll notice is the lengths our people go to understand the hurdles that stand in your way, and then to find innovative ways to help you jump over them. That's the value of RSM. That's the power of being understood. In over 120 countries, there are RSM experts who take time to find out what makes you and your business tick. Wherever you are and wherever you want to go, our audit, tax and consulting services are designed to help you move forward with confidence. It's your ambitions we care about, and like you, our focus is on your future. The advice you receive may come from individual RSM experts, but it will be supported by our collective local and global knowledge, helping you grow and safeguard your future. That's the value of RSM. That's the power of being understood. At RSM, we have over 40,000 great minds that take the time to find out what makes you and your business tick. Our audit, tax and consulting services are designed to help you move forward with confidence, but it's how we do it that sets us apart. RSM's experts take time to understand what matters most to you, which means you receive advice that goes beyond your expectations. What you'll notice is the lengths our people go to understand the hurdles that stand in your way, and then to find innovative ways to help you jump over them. That's the value of RSM. That's the power of being understood. In over 120 countries, there are RSM experts who take time to find out what makes you and your business tick. Wherever you are and wherever you want to go, our audit, tax and consulting services are designed to move forward with confidence. It's your ambitions we care about, and like you, our focus is on your future. The advice you receive may come from individual RSM experts, but it will be supported by our collective local and global knowledge, helping you grow and safeguard your future. That's the value of RSM. That's the power of being understood.